Greetings and a warm welcome to the Center for Global Development's event on strengthening South Asia's fiscal resilience through enhanced revenue mobilization. I'm Sanjeev Gupta, Senior Fellow Emeritus at the Center, and I'll be moderating the event today. So today's discussion will focus on South Asian countries, how they can navigate the current challenges they're facing at the current juncture and difficult fiscal conditions by enhancing their revenue mobilization efforts. Strengthening tax revenues is also crucial for addressing climate change and financing the Sustainable Development Goals. Like many other emerging markets, South Asian countries are responding to COVID-19 pandemic with substantial fiscal support to protect lives and livelihoods. At the same time, revenues declined due to reduced economic activity, resulting in a weakening fiscal positions. Between 2019 and 2021, every country in the region saw a rise in its debt to GDP ratio, albeit to varying degrees. In some cases, interest payments on domestic and external debt began to surpass spending on education and health. Not all countries experienced a robust post-pandemic economic recovery. In those where the growth remained sluggish, debt burdens worsened, prompting governments to adopt fiscal consolidation measures by raising revenues and curbing expenditures. Several countries initiated adjustment programs supported by the IMF. So there is an ongoing debate among economists about how appropriate balance of fiscal consolidation should be, whether it should rely more on spending cuts, revenue increases, or a combination of both, and which approach is most conducive to sustainable growth. These questions are central for policymakers. One consistent finding from the literature is that the dynamics of fiscal consolidation differ between advanced and emerging economies. In the latter, revenue-based consolidations tend to be more supportive for long-term growth. This is because higher revenues allow for greater investment in human capital and infrastructure, both essential for sustainable development. A minimum threshold of taxation is needed to create fiscal space for these investments. Estimates of revenue potential vary. IMF suggests emerging markets could raise an additional 5% of GDP. The ADB estimates 4% of GDP for developing Asia. The estimates which I was involved in preparing. And the recent World Bank South Asia update estimates between 1 to 7% of GDP potential for South Asia. The message is clear. There's a significant untapped potential for revenue mobilization through tax policy and institutional reform in South Asia. A related and important question I anticipate will come up in today's discussion is whether fiscal adjustment reduces or exacerbates income inequality. The answer will depend in large part on how tax reforms are designed. So we are fortunate to have a distinguished panel of experts from across the region. But before we dive into the discussion, I'd like to invite Francisca, who is Chief Economist for South Asia region of the World Bank, to set the stage with insights from the bank's latest South Asia update. Francisca, the floor is yours.
Thank you, Sanjeev. It's a pleasure to be here today on the screen. So thank you. Yeah, I'll just give you as background, just touch on three questions. First, growth prospects. Second, what does that mean for fiscal positions? And at the bottom, growth prospects are dimming, but fiscal positions remain a source of fragility in the region. And really at the root of fragile fiscal positions are low revenues. So I'll show you how low in the second question, and then I conclude with some policy priorities or policies and options that come from the rest of the world, from the literature and our research. So just to illustrate you growth prospects, the region does continue to be the fastest growing emerging market and developing economy region. You see in the chart on the right the growth rates in South Asia in the red bars and in other emerging markets and developing economies. But the region is growing less fast than we had anticipated in just 6 months ago, in October. In the chart on the left, you see how much we've downgraded our growth forecast for just about every country. Even in some ways, Sri Lanka, we've downgraded because before the recent shocks happened, we were planning an upgrade. So the region does continue to grow faster than others, but the gap is narrowing. And of course, it's becoming harder and harder as the global economy becomes more challenging. That is the most likely outlook, the baseline outlook. On top of that, these growth prospects are subject to heightened downside risks. They're really severe, and the region is vulnerable to these downside risks, especially financial risks, simply because fiscal conditions are very fragile. Here in the chart on the left, you see one example, one symptom of fragile fiscal positions: government debt. In most countries in South Asia, government debt is well above the emerging market and developing economy average. And on the chart on the right, you see how much South Asian governments spend on interest. Sanjeev touched on this already, that interest service burdens are really heavy in the region. And at the root of these fragile fiscal positions really lie low revenues, tax revenues in particular. Here, so just to give you the broad number, revenues as a whole, not just tax revenues, revenues as a whole in the region average 18% of GDP compared to an emerging market and developing economy average of 24% of GDP. The subcomponent of taxes is what you see here in the left chart. The pink bar is the interquartile range of emerging markets, of 150 plus emerging markets and developing economies. You can see that more than half, most South Asian countries have tax revenue ratios that are in the bottom quartile, among the lowest quarter of emerging markets and developing economies. India is just above the bottom quartile, but is well above the emerging market and developing economy average too. And the odd thing is that is despite high tax rates. So in the chart in the center and the chart on the right, we show you the tax rates. For direct taxes, so income taxes, corporate income tax, personal income taxes in the center, and for indirect taxes, so that's consumption taxes and tariffs in the right. So consumption taxes are things like sales tax, excise tax, value-added taxes. You can see that half of these tax rates are actually above the emerging market and developing economy average, but revenues are well below. And if you formalize that in a stochastic frontier analysis, you can estimate the gap. So the analysis shows you what would be the maximum possible revenues you would expect to gather, and you compare that with the actual revenues. So for example, for personal income tax, here on the left, or for consumption taxes in the center. And you can see that shortfall, that revenue shortfall, is somewhere between 1% and 7% of GDP across all these different types of taxes. And it's really broad-based. The biggest shortfalls are, of course, in Pakistan and in Sri Lanka, but also in Bangladesh. The chart on the right shows you decomposition by different types of taxes. And again, you see the orange bars, these consumption taxes tend to be the largest. And personal income taxes also tend to be the largest revenue shortfalls. Now, some of it, the first response to that is, of course, that, yeah, but these economies are very informal. So, of course, it's very hard to, by definition, by construction, it's very difficult to collect taxes on these economies. Also, these economies have very large agricultural sectors. On average, across South Asia, 42% of the workforce is employed in agriculture. 16% of GDP is agriculture. And agriculture tends not to be taxed in most countries. And the third frequently cited argument is financial development. Generally, across the region, financial sectors tend to be underdeveloped, and a lot of the capturing of taxpayers often happens in the context of loans. So you can only get a loan if you have, for example, a tax identification number. So if you have a very underdeveloped financial system, it's very difficult to even identify your taxpayers. So we formalize this in a regression analysis and estimate how much of these shortfalls from the previous slide can be explained simply by these three factors. Large informal economy, so 30% of GDP, 90% of employment, so large informal economy, large agricultural sector, 16% of GDP, 42% of employment, and underdeveloped financial systems. And the blue bars are what you get. So the golden diamonds show you what was in the previous slide. These are the revenue shortfalls just based on tax rates and tax bases that we're trying to explain, the revenue shortfalls. And then the blue bars show you how much of it can be explained, by these three factors, structural economic factors. And other than Nepal, it's no more than half. At most, half of these revenue shortfalls can be explained by simply the economic structure of South Asian countries. Which brings us to the policy options. Clearly, there is something more missing. What is needed is not so much tax rate increases. What is needed is an expansion of the tax base. It's the removal of exemptions. It's the elimination of loopholes. It's the streamlining of tax codes. In Pakistan, for example, state taxes, there's state taxes on agriculture, and they're all different. This should be streamlined. No, goods and services taxes are sometimes different in every little province, every little state. It has to be streamlined. So just a streamlined simplification of the tax code. I believe that also partly applies to the GST in India, just streamlining of the tax code, and then, of course, tax administration. So let me give you two examples before I close. On the exemptions, look at the chart on the left. It shows you the threshold income at which you have to submit a personal income tax claim, scaled by GDP per capita. For example, India, Pakistan, Afghanistan, Bangladesh, Bhutan, a household that earns the average GDP per capita in income does not even have to declare, is exempt from personal income tax. That's very high. That's very high. So you see the emerging market average with the line here, that is very high. That's much higher than the average. So there are large exemptions. The tax net is just very small. I believe in Sri Lanka, the personal income tax base is just one factor. It's 3% of households pay personal income tax. It's just a very small tax base. So that's on the exemptions. Just reduce exemptions, basically. That's the policy option. On the tax administration, it's interesting. The literature has moved into a lot of interventions that try different ways of improving tax administration. So these are very simple interventions. They're often just an invitation to the tax bureau. They're a letter reminding people to pay. There is a text message and sending a link where you can e-file your taxes. So these don't need to be expensive. Most of these interventions from 26 studies in 17 countries, 87 interventions, most of these are small little things. And you can see the revenue impact in that chart in the center from our meta-regression analysis. They can almost double revenues with small things. But the most efficient, the most effective interventions are those that focus on enforcement. And that's what you see in the chart on the right for income taxes, direct taxes, and VAT. You can see, again, this is our meta-regression analysis, the interventions that change the incentives for tax officials to collect tax officially and that improve enforcement, those tend to be the most effective ones. The ones that are the least effective in this particular literature are the ones that are about facilitation, simply e-filing or making it easier to pay taxes. But of course, that literature always focuses on intervention. It neglects the fact that a lot of the enforcement action can only be done once you have the taxpayers in the net. And that's the kind of thing that tax facilitation and tax identification does. So for all these taxpayer identification, that's what they do. They define the net and then you have an enforcement on top of it. But those interventions don't need to cost a lot of money, but can be very effective. So let me conclude. Growth prospects have dimmed across the region, and there's likely to be a lot of shocks, adverse shocks hitting South Asian economies. So it's now more important than ever to create more resilient fiscal positions, And that means raising revenues. And it means not raising taxes necessarily. It means broadening tax bases by removing exemptions and improving tax administration. And now I'm very much looking forward to the discussion. Thank you.
Thank you, Francisca, for an excellent overview of South Asian economies. Well, let me now start by introducing our panel. And one of the panelists, Vijay just joined, so we have the full panel. So let me start by introducing our panel. Kavita Rao is the Director of National Institute of Public Finance and Policy in New Delhi. She has written extensively on fiscal issues in India and has served on several government committees. Ijaz Nabi is a member of Pakistan's Prime Minister's Economic Advisory Council. He spent 22 years at the World Bank in Washington and until recently was a non-resident fellow at the Center for Global Development. Murtaza Jaffrji is the chair of the Advocata Institute in Colombo. He previously served as a director of Colombo Stock Exchange, Nations Trust Bank, and Serendeep Hotels PLC. So let me, before I start the discussion, let me also sort of inform where the audience can send their questions to. They can put them in the YouTube chat or on the events page of the what you see on the screen. So let me start with a question for Kavita. And you know, a lot of us have watched the implementation of GST or equivalent of VAT in 2017. And so the issue which we wanted to understand from you, has the collections from GST stabilized? What is the potential for further revenue growth from GST? And question that comes to everybody's mind, people who've been looking at digital technologies, is has the taxpayer trail facilitated improved collection of other taxes, including those from income? So I'll start with this question and appreciate your response to that. Thank you.
Thank you. Thank you very much for inviting me to this panel. It was an interesting initial comments by Francesca. The GST, as it was introduced in India, I guess we've heard the good and the bad of it over the years. The challenge for GST in India has been that it was introduced in a context where soon after the country went into a few shocks, not the least of it being COVID, which affected the economy for 2 years. So the first 3 years of GST's implementation were very disturbed, and the performance was not good. In the last 3 years, however, revenue performance has been buoyant with modest increases in the tax to GDP ratio. So the ratio has increased from about 6.3% in 2021-22 to about 6.82% in 24-25. It's not a dramatic increase, but about a half a percentage point increase. So that is how we are doing. I think one expects the tax to GDP ratio from GST to remain stable, perhaps increase modestly, but one doesn't expect dramatic changes without any further changes in tax policy in GST. As Francesca mentioned, the tax structure of GST in India is very complex. It has 5 different rates. While the intentions of policymakers is to reduce the number of rates to get to a fewer rate regime, it is politically a challenging process because the rates on some commodities would need to be increased while those for other commodities will decrease, and the acceptability of such a reform often questioned. Without dramatic changes, I would expect it to stabilize at about 7% of GDP, but I don't expect it to go on increasing thereafter. Turning to the second part of your question, what happened to other taxes? The big element, the big tax to talk about is non-corporate income tax in India. And this tax, in the period from, let's say, 2021 onwards, has shown very high buoyancy. The average growth rate has been between 18 and 24%. As a result, you're also observing an increase in the tax to GDP ratio from 2.45% to about 3.82%. So it's more than 1.4 percentage points increase. So that's a sharp increase. Looking at the composition of incomes reported, however, the evidence is mixed. The income tax department does put out information on the kinds of incomes reported in the return. One would expect with higher growth in that with GST and with the paper trail, the business income component could grow faster. What one observes, however, is for individual tax, the salary incomes have grown faster than business income, while for firms, they have reported a faster growth in business income. So it's a mixed bag in terms of what positive impact one can observe from the introduction of GST.
Thank you, Kavita, for explaining the developments in the GST and income taxes in India. Let me now turn to Ijaz. And Ijaz, Pakistan currently is having an IMF-supported program that is mandating fiscal consolidation, which is focused primarily on the revenue side. So what challenges have you seen in meeting these revenue targets? And of course, the same thing applies also to Sri Lanka, but I think we would like to hear first from you what challenges you faced. You are muted.
Thank you, Sanjeev. Thank you, Francesca, for this opportunity to engage on an important topic. So, Francesca, in addition to all the contextual problems that South Asia faces in improving its revenue base, in Pakistan, you also have to have the additionality of the IMF program. Now, Pakistan is particularly prone to quick translation of a fiscal deficit into a current account deficit and then balance of payments crisis. And that's because of low savings. So borrowing by the government is expensive. And it's also because till the late 1990s, Pakistan had the highest tax to GDP ratio in South Asia. And today it has the lowest. So the two combine and very quickly turn a fiscal deficit into a current account deficit and balance of payments crisis. Now, the IMF program actually addresses both the revenue as well as the expenditure side. Now, the revenue side has problems because 2/3 of the budget is rigid. A third is interest payments. You can't do anything about that without a major shock to the system. Most of it is domestic borrowing. And the other 1/3 is defense. And for reasons that we won't go into in this conversation, that is also out of bounds for adjustment. So that leaves you 1/3 of the budget to play with. So essentially, and the overall size of the government is not large by international comparisons. It's about 21% of GDP. So if you want to adjust 1% fiscal deficit, you want to bring it down by 1%, you have to reduce expenditure by 5 percentage points. But because of rigidity within the expenditures, you have only 1/3 of the budget from where you can get the adjustment. So 1 percentage point of fiscal deficit reduction means almost 15% reduction in your rest of the in your budget, and that's huge. Most of the hit, therefore, is on the largest component of the budget where there is some flexibility, which is the energy subsidy. Which is why Pakistan has seen massive adjustment in the energy sector in terms of energy prices. And Pakistan now has one of the highest costs of energy, which doesn't do much for growth. Now, of course, given the rigidity on the expenditure side, then the question is, what can you do on the revenue side? Now, and there is a lot of expectation on the revenue side because IMF did a working paper in 2011, which showed that Pakistan's tax potential is 21% of GDP. Now, of course, when you see that, you say, well, you have the potential. Why don't you realize it? Well, easier said than done. If you actually look at the performance in terms of how much Pakistan has actually collected in the last several years of pursuing fiscal reform, it turns out that between over a longish period of time, in India, a tax to GDP increased from 13.4% to 18.5% by 5 percentage points. In Nepal, by 9 percentage points, and in Pakistan by 3 percentage points. So the potential is set by that IMF paper. The reality is, as I have told you. So what happens? Why Pakistan does not realize its tax potential or realizes it in a less than satisfactory manner? A number of reasons. Pakistan has South Asia's largest informal economy. Huge amounts of remittances are coming in. There's a porous western border. So there's a lot of informality, which makes it very difficult to collect taxes. Another factor is that the structure of the economy is changing in a way which is making it difficult to collect taxes, particularly sales tax. You have more and more the share of services in GDP is increasing, and unlike India, the GST on services is collected by provinces who have relatively weaker tax administration compared to the center. So these two factors, plus, of course, all the exemptions, and Pakistan has a plethora of exemptions, very nice tax policy, very nice tax law, and then you begin to pick holes in the bucket. And at the end of the day, you're losing nearly 2.7 percentage points of GDP because of the exemptions. So all of these things come together and results in very poor revenue performance that we see. And yet, the IMF in its review for the current extended fund facility expressed satisfaction in how the government was intending to pursue reform. And that was in May, June of 24. And I looked at the March assessment by the IMF, and again, it sounds very positive. What are some of the steps that the government has taken which makes the IMF look positively? The Federal Bureau of Revenue has put out a program of primarily administrative reform, in which they emphasize that Pakistan's expenditure on tax administration is among the lowest in the region. This is expenditure on tax expenditure as a share of the revenue collected. And one of the arguments is that this will need to be increased, and it'll need to be increased in a number of ways. One is digitization. Digitization is ongoing. It's a very deep program of reform. It has been reviewed by the IMF, and the March review suggests that there is satisfactory progress. There is also a lot of discussion on improving HR capabilities, particularly capabilities that will improve audits. The FBR in its presentation has a very nice slide which shows an extremely venomous snake, which has real bite, and a mimic. Apparently, in nature, a mimic snake exists that looks exactly like the venomous snake, except that it doesn't have any bite. So what FBR is saying is that at the moment the audit is exactly like that mimic snake. It looks like a venomous snake, but it has no bite because the FBR doesn't have the personnel and the capabilities to actually pursue adequate audits. There's a lot of detail in that report on how they are going to go about improving this. Importantly, from a political economy dimension, and in your next round of questions, I will speak more about those. Pakistan is beginning to address the political economy nature of the agriculture income tax. At the moment, collection is very poor. And that's because large farmers are represented in important political parties, and they've been able to keep the agriculture sector out of the tax net. At the end of the day, agriculture will not yield a lot of revenue, but agriculture will come into the tax net, which means that all the other income that is shown as agriculture income will be found out. And so it'll help improve the rest of the tax base. This was a politically difficult issue, reform to push through, but all the provinces have, it's a provincial tax, and all the provinces have now concurred on implementing the tax. So overall, things are moving in the right direction, but there still remain many challenges.
Thank you, Izaz. This was a very interesting presentation from your side. Of course, we'll come back to some of the issues in the next round. Murtaza, if I may turn to you. Sri Lanka is also having an IMF-supported program, and there's a lot of focus, as it is in Pakistan, on revenue mobilization. And in case of Sri Lanka, the VAT performance had really come down quite significantly before the program. So perhaps you can discuss how progress is being made, and are we going too fast in that direction in terms of fixing the tax system? Your views, please.
Yeah. May I have my slides, please? All right, next. Next. So let me explain the structure of the tax system in Sri Lanka. So 28 years ago, we had taxes as close as 19 to 20% of GDP, maybe 25 years ago. And today, basically, at the low point, it came down to 7.5%. The slide that I have shown shows you the structure of the tax collection. So indirect taxes, this is only up to 2021. Indirect taxes account for about 75 to 80% of taxes, and direct taxes are only 20%. This structure, various political parties have been saying that they would like to shift it to 40% direct taxes, 60%. But even with all the recent changes and improvements in performance, this has not happened. Next. So the Sri Lanka was lucky that we had a GST system that was introduced almost 20 years ago that then evolved into a VAT system. Now, what the chart at the top shows you is the kind of political games that politicians played with the mistaken intuition that it will spur economic growth, that they started meddling with the VAT system. So VAT accounted for 25 to 30% of total taxes collected. And what the chart on the top shows you is the amount of changes that have been made in the VAT rate. And there's a bar graph at the bottom showing the kind of changes that they made to the VAT threshold. So prior to the crisis, I mean, the VAT threshold was increased by 10 times, 10x. At that time's exchange rate, something like $1.5 million, which is extremely high. I remember an IMF paper recommending between $50,000 and $100,000 as the VAT threshold. Next chart, please. So this shows you the tax rates. And again, it's going up and down. And there were different rates for small businesses and large businesses. So what has been done is that there is now one fixed rate of 30%. And many of the exemptions and the multiple rates that were given for different businesses have all been unified at 30%, the corporate tax rate. Next, please. The third avenue of taxation is personal income tax. And not only have they been changing the rate of tax, but they have also been changing the thresholds. And at one time, our threshold was 4 times per capita GDP. All of this has been now revised down. We have 4 bands of personal income tax. The highest band is at 36%, and that is eligible to about top 5% of households or less. But unfortunately, the new government that came in 6 months ago gave assurances that they would give some reprieve to working professionals, and they increased the minimum tax threshold by 50%. So our minimum tax threshold is now above GDP per capita. And they also changed some of the tax bands. And the IMF has recently calculated that only 15% of the households are coming within the tax threshold. Also, under the Sri Lankan legislation, a husband and wife don't jointly file tax returns. Each person files individually. Next, please. So this shows you the problem that Sri Lanka had, that nominal GDP was growing, the tax and even the expenditure, primary expenditure, because we were also a highly indebted country. And although we were running large fiscal deficits, most of the deficit is dominated by interest. In fact, we have one of the highest interest to GDPs in the world. Last year was about 8.5% of GDP, because you're carrying a public debt to GDP, even after debt restructuring, of about 110%. So what you can see is that we are achieving primary balance surpluses, but primary expenditure has come down significantly because interest is dominating total expenditure. Next, please. And the next chart shows you as a percentage of GDP what all those measures look like. And you can see that revenue to GDP is going up. Next. So that answers the first question, Sanjeev.
Okay, thank you so much, Murtaza, for elaborating the state of affairs of Sri Lanka. You know, in the 90s, I used to be fiscal economist for IMF. So I followed Sri Lanka for some years, and I know a little bit about Sri Lanka. And then I was overseeing in the fiscal affairs department at the IMF some of these issues coming from Sri Lanka. So let me turn to Ijaz again before going back to Kavita. Ijaz, tax rates, you talked about it, tax rates are high in Pakistan, and this is something which was made clear at the beginning of the presentation. So basically the challenge that policymakers are facing, how to broaden the tax base. And so what is that, from your perspective, the Pakistan can do to broaden the tax base? You talked about how the agriculture incomes are going to be taxable, which would help broaden the tax base. So this is one measure. Last week, I heard the Finance Minister of Pakistan speak at the Center for Global Development. He talked about this issue as well. But I want to hear your views as to what you think would help broaden the tax base if you had the full canvas which is available to you?
Thank you, Sanjeev. One consequence of the endless stabilization program that Pakistan has embarked on since 2008 is that, well, there are a bunch of consequences, but one important consequence from the tax side is that we now have one of the highest corporate tax rates in the region. World Bank recently put out an excellent report on productivity growth and titled it Swimming in Sand, which I took a great deal of offense to. but as far as stabilization is concerned, that's the title is apt. The World Bank ranks us as the highest tariff rate, perhaps in the world. I think only Egypt had higher tariff rates than us. So we have resorted to, taxing the golden hen that may eventually lay eggs. Investment is not going to come with these high corporate tax rates, and exports are not going to revive with these extremely high tariff rates. So that's a struggle that we are continuously engaged in. I'm on several committees to look at potential for tariff reform. And the reason is that it's not just the customs duty, which is the standard tax on trade that we have. We have additional customs duty, we have a regulatory duty, and then we have all kinds of withholding taxes, withholding income taxes. So at the end of the day, it becomes a huge burden to continue to export. So those are all critical issues that need to be addressed in the expansion so what do you do? How can you do it if you still want to meet the fiscal stabilization target? You of course need to do some of the things that the government has done in the last few months. One is really get rid of as many exemptions as possible. Now, don't forget that in the overall mix of things that Pakistan is confronting, we also have a highly unstable political structure. It has been since 2008. Very few prime ministers have completed their full term for a variety of reasons. Government have been changed. When you have those kinds of changes going on, it becomes very difficult to take on strongly vested lobbies in the existing tax structures, with all the exemptions that there are, with important segments of the economy being excluded from the tax break. Take, for example, the two sectors which have grown the most in the last 40 years. Pakistan receives almost $38 billion in remittances every year. That's a lot of dollars. And where that money is going is largely retail and real estate. And the two sectors are extremely poorly taxed. Real estate in particular is very poorly taxed. And bringing the real estate lobbies into the tax net in an unstable political environment is a real challenge. But the Prime Minister seems committed. I'm on the advisory council, but the advisory councils don't have any statutory standing. They are exactly what they are called. You come and talk and you go away. If the Prime Minister is moved, he may do something about it. Otherwise, you just get to have a floor to address the Prime Minister for a few minutes. So he seems very engaged. He seems very committed, both to improve, to bring the real estate sector into the tax net. On retail, there is still some There's still some hesitancy because those lobbies are very strong. They go to the heart of the political party that he heads. So we are going to that's going to be more of a challenge. But things seem to be moving on the real estate sector. But I want to raise a word of caution. I recently saw a paper by a very good fiscal economist, tax specialist. He was talking about this extremely aggressive drive to increase the number of tax filers. This is in the context of income tax. And Pakistan, apparently, according to his estimates, and he has access to FBR data, was able to have an eightfold increase in the number of filers in a relatively short time. Very aggressive approach to bring people into the tax net. What Mazhar Wasim has criticized is that if you assign that as a priority task to FBR staff, they will spend an awful lot of time on a drive which yields very little revenue. So the number of filers has increased eightfold. The tax to GDP ratio has not moved, which means that they're bringing into the tax net lots and lots of small guys who would probably fall below the threshold and therefore do not, the actual yield is very low. And yet there's a lot of fanfare and a lot of announcements. So the paper is cautioning against a poorly thought through attempt to increase the tax base by bringing in all kinds of non-filers. So keeping that in mind, and keeping in mind the fact that government is beginning to move to bring the real estate sector into the tax net, I'm optimistic that, and so seems to be the IMF team, given the March review, that things are moving in the right direction to expand the tax base.
Thank you, Izaz. It's a very interesting example of how tax administration can actually waste resources in trying to get new taxpayers who don't really provide any revenue. So very interesting example. So let me now turn to Kavita before going to Murtaza. Sticking to the discussion on relatively small tax base for income taxpayers in India as well. In India, in the last budget, they increased the threshold. So really, the threshold is in relation to per capita is very, very high. So what do you think can be done in India's case to expand the direct tax base? And we'll come to that in a minute. There are political constraints to how far you can go, but what are the practical suggestions that you will give to the tax department to expand the tax base given the circumstances?
Well, an interesting question, something which at the Institute in worrying about for some time now. I think we are talking about two broad strategies of expanding the tax base. One is to reduce exemptions and concessions, and that driving the process of bringing more taxpayers into the tax net. Where we are hitting a circularity in argument in the country, perhaps in other countries as well, is when the number of taxpayers is small. That happens to be the relatively well-off middle class. Every few years, you have to give them SOPs to keep them happy because they believe that they are carrying the country on their shoulder. So this has been a repeated process for India where exemption thresholds are held unchanged for a period, but then you'll have a sharp increase. The last increase, as you mentioned, is in the last budget where we've now increased the effective exemption threshold to about 4.5 times per capita income. Everybody with income above 400,000 rupees is expected to file a return, but they can claim deductions for incomes of up to 12 lakhs, that is 1.2 million. So that's a large amount of exemption, which in effect means there are very few people actually be paying tax. So in India, we do observe that while the number of people filing a return has gone up to about 7.5% of the population, the number of people paying tax, so returns with positive income, will be about 40% of those 7.5. So that is one challenge that has been on our cards. Here, I think it's interesting to point out that India has introduced an alternate tax regime, which is effectively proposing to incentivize taxpayers to choose to not avail exemptions. So we have the 12 lakh exemption that you've mentioned. It applies only if you give up the choice of every other incentive that the income tax regime incorporates. So savings incentives, anything to encourage housing, children's education, most of these are not available to you. So this is like a trade-off. These alternative regimes, one with exemption, one without exemption, exist in corporate tax as well as in personal income tax. And we are hoping that in a few years, the exemption regime will become redundant and can be written off. And then we have a regime which has no or few exemptions. And that can be one way to ease out people without facing a backlash. So that having been said, I think one needs to also keep in mind that unless the number of people in the income tax regime is expanded, everybody who does pay the tax feels a lack of fairness in the regime, and so the group of people, the stakeholders who argue for an increase in exemption threshold keeps increasing, and the people who are not paying tax are not keen to. So there is no constituency which is arguing for a lower exemption threshold, and that creates a problem in itself. Just one additional little point of information: the ratio of peak rate to lowest rate in India, I think, is much higher than what the study suggests. Because we are looking at a lowest rate of about 5%, whereas the peak rate crosses 40%. So the ratios are much larger than what the study is working. And so I don't know if that affects your results. I'll stop.
Thank you, Kavita. Let me turn to Murtaza. Murtaza, you've heard the previous two speakers talk about income taxes and other forms of direct taxes. In Sri Lanka at present, a lot of emphasis is on raising revenues from VAT. It had from 7 to 12% of GDP. This is a big shift over a period of time, in a short period of time. So what do you think the government will be able to sustain this level of revenue increase from VAT? Do you see any issues with it going forward? You're muted.
All right. May I have my slides, please? So whilst it's being loaded up, I think the World Bank report tried to measure what they call tax gap. They have taken into account country characteristics and tax policy and tax base and try to assess. Sri Lanka's statistics are a bit outdated because there have been significant changes, but nevertheless, there is a large tax gap. I wanted to share these series of graphs from an IMF research report that shows typically what proportion of GDP various forms of taxes are. And for a middle income or just transition to upper middle income, our VAT to GDP should be around 6%. And since we have some other taxes in lieu of VAT called a social security levy, which is a transaction tax of 2.5%, but if you add that to VAT, we are around about 4.5%, which is still significantly lower than a country like Sri Lanka should be. Next, please. So in sustaining this, this is a graph of where the economy is real GDP. and we are still about 5.8% below where we were in 2018 due to the significant contraction that the economy went through. Next, please. And there are many sectors that are contributing to the recovery, and construction sector, which was one of the leading sectors that drove growth for a long period of time, had one of the largest contractions, something like 75%, which is also coming back. Tourism, those of you who have visited Sri Lanka will come to know that this is a pleasant place to visit, is growing. And one of the challenges is that since there's a lot of digitization and platforms, the question is that are all the tourist dollars that are supposed to be spent in the country being captured in the country? So there has been some revision to how digital businesses are being taxed. Now, Sri Lanka is not a signatory to BEPS 1 and 2, but BEPS 1 would have given us the ability to tax some of these platform companies. Our tax administration abilities are quite weak, but in terms of tax buoyancy, Sri Lanka has had quite low tax buoyancy because not only administrative issues, but a lot of the leading growth sectors previously were either on concessionary tax rates or were exempted or difficult to tax. Next, please. So I just break down some of the tax policy issues that bedevil Sri Lanka. One is that I asked a question, should the VAT tax rate be increased? And I say yes. And my reasons is that in lieu of VAT, we have all sorts of other highly distortionary taxes that cascade, that are transaction-based, etc. So my sense is that we should get rid of all those highly distortionary taxes, some of it on trade, and consolidate it completely to VAT, which is a much cleaner system. I read in the World Bank report, this is one thing that I disagree about, multiple VAT rates. And Sri Lanka, once upon a time, had multiple rates, and it creates huge amount of distortion because the input and the output credit, people play games and shift the rates. So I don't think that's a good idea, certainly for Sri Lanka. We have zero and a rate. Then you have the issues of base widening. So even in VAT, we have exempted, we have closed a lot of exemptions, but we still have exemptions. And for example, electricity, but petrol and diesel have. To me, they're both sources of energy. So what's happening is that when you exempt some sectors and others, it's creating distortions. It's creating problems with relative prices. And the best example I can give you is a market for protein. For some reason, they have exempted fish, but not eggs and chicken and beef and pork and any other kind of protein. So, you're advantaging one group over another group, which should not be happening. And nobody really talks about the distortionary effects of these exemptions. Also, I asked a question about VAT. All over the world, they set the threshold based on revenue. Sri Lanka anyway has very high threshold at something like $200,000, and the World Bank, the IMF has recommended between $50,000 and $100,000. But in a country that has a fairly large service sector, something like 55 to 60% of GDP, the threshold means revenue for a service company and a goods company means two totally completely different things. So I'm asking the question, should we set the threshold based on value added instead of revenue, which is less distortionary? And then we also have the problem that since our threshold is at $200,000, people are spawning new entities to be below the threshold, especially the service income. And that way they're avoiding being legally under the VAT threshold. The next slide, please. On tax administration on the VAT, there's a lot of complaints because of poor administration that the refunds don't come. Now, I would like to just talk about digital invoicing. I think we have to take a leaf out of India's book, where they have periodically brought the threshold for uploading digital invoicing, which I think Sri Lanka is looking increasingly towards digitization, because if we mandate digital invoicing, not only are you collecting a large amount of data, but the incentive to avoid will come down. The next is, next please. I'll accelerate. I'll just show you. This is, we talk about digital payments, more and more digital payments, and these are credit card payments. And you can see that with the recovery in the economy, etc., this is going up. Next, please. This shows you debit cards. So that is also increasing. But next, please. This is cash in circulation. And this doesn't correlate with nominal GDP. That there is, you see these peaks because we have festive season in April, so they use a lot of cash and gift giving. But you can see structurally that something is not right, that there's a significant expansion in cash in circulation. And the next slide, please. This is the denominations of the currency notes. So you can see that the 5,000 Sri Lankan rupee note, which is about $16, it is growing faster than basically all other denominations, indicative that there is wide-scale avoidance going on, because why should there be such a large increase in currency in circulation which does not correlate with nominal GDP growth? My final comment on this is that Sri Lanka was one of the few countries, or the only country in Asia, that did a IMF governance diagnostic analysis. So we had a pivotal election where all the traditional parties were voted out of power, and we have a new government that came on the base of good governance. Unfortunately, this country does not have a social compact. So most people are reluctant to pay taxes because basically they think that there is a huge governance issue and the taxes that they pay will not be utilized for the benefit of the people. So although the IMF and our authorities have done a remarkable job of improving tax collection, the citizens' willingness to pay taxes basically has not improved. And that has to be socially and politically tackled. And to me, in answering your question, can this be sustained? I think that governance and social dimension and that social compact needs to be put in place so that people are more willing to pay taxes.
Thank you, Murtaza, for a very elaborate response. And just two things. One, Pakistan also had a governance mission recently.
Yes.
So Sri Lanka is not the only one. And secondly, one reason people are not willing to pay taxes is because they are not sure about the quality of services that government is providing. So I think these two things have to go hand in hand. But we can come back to that in a minute. But before we go to the next question, for which we don't have much time left, I would like to give the floor to Francisca to react to something, but in very short time period, so that we can go back to one final question, which I believe is important for us to hear the response to the panel to. So let me pass on the floor to you, Francisca, for a short overview of what you've heard from the panel.
Thank you, Sanjay. It struck me from all my three colleagues that tax is so much more than tax. So both Ijaz and Murtaza spoke about trade. I mean, yes, our region relies more than any other region on trade-related taxation than the other direct taxes. And that has implications way beyond revenues. It makes this the least open region to global trade. Then there's political economy in there. You just spoke about this agricultural income tax. It's a big deal. It's a massive political economy breakthrough. The issues go well beyond tax. Kavita spoke about the increases in PIT and VAT in India, and a good amount of that was actually related to financial development. It's the India stack that makes it very easy to get receipts, to what Murtaza was also speaking about, is VAT invoices. You have it all easily accessible. It's very easy then to report. And same with income tax. It becomes very easy to report. So it's striking how far much more tax policy is than simple tax.
Thank you, Francisca. Let me very quickly go over to the final question, which I'm sure is a back of the mind of the panel. And since we have only about 10, 11 minutes left, so I'll give 2 minutes to each of the panelists to respond to that. And let me start with Ijaz, which is to what extent your tax system is addressing the income distribution issues in the country, and what can one do to improve the tax design of the tax design to effectively also focus on this aspect of tax policy.
Thank you, Sanjeev. I'll take less than 2 minutes. I'll just pick up on what Francesca said. It really matters. It's not just the tax issue. You have to look at the whole fiscal stance and see whether that is promoting equity or not, which means you should look at your principal expenditures. Are they delivering to people to address the willingness to pay issue? On that score, there's been some improvement. The Benazir Income Support Program is an extremely well-designed program. It has problems. It has things that still need to be fixed. But by and large, an excellent highway to the poor. And the government has been improving that continuously. So that component of the expenditure is turning out to be good and continues to be improved. I think the removal of energy subsidies has also promoted equity because these were extremely poorly targeted subsidies. The more air conditioners you had, the more subsidy you got. So I think getting rid of that subsidy and then tying up the next round of targeted subsidies to income-based targeting using BISP and other platforms would be the right way to go, and that's something the government is striving towards. The tax-specific, revenue-specific equity issues. In Pakistan, the most significant equity dimension is the horizontal equity across sectors of the economy. Huge sectors, as I said previously, real estate sector, large part of the retail sector, the agriculture sector, they were exempt. And I think to the extent that the government is showing some willingness to address those will help improve the equity dimension on the revenue side. But at the end of the day, the system has to deliver growth and the system has to deliver jobs. And therefore, you have to look at whether you are raising your revenues through customs. And if you are doing that, you are not going to create jobs. You're not going to get exports. And therefore, the system will look inequitous and people's willingness to pay taxes will not improve.
Thank you, Izaz. Kavita, the same question for you now. And
yeah, quickly, two points I'd like to make. Within the income tax regime, I think we have too many slabs now. We moved from few slabs to many slabs. So we have built significant progressivity in the way the tax structure is system is structured. Because we have high exemptions, we don't effectively incorporate a bulk of the tax structure, and therefore you can call that progressivity. But if you want to look at wealth inequality, I think we have a challenge because the mobility of high net worth individuals out from within the country to other domains, as well as the perceived financial treatment of FDI in compared to domestic investment, pose challenges on whether you third final point, and I'll stop after that. Perceptions are important. Governments are doing substantial amount of work trying to provide various kinds of social security programs. It might be of use to call one of them a DBT for tax paid on indirect taxes and like a rebate on taxes paid. And that might open up the space to remove a lot of exemptions that we have currently built into our indirect taxes regime. The rationale for giving exemption seems to be that we would like to make products available to the poor. Since we have a fairly DBT program, we might want to consider stepping away from exemptions and providing resources directly. I'll stop there. Thank you.
Thank you, Kavita. But just to throw in a statistics here, the Gini for wealth inequality for India is twice as high as the Gini for post-tax income. So the wealth inequality is very high in actually not only in India, but most other countries. So Gini there is much, much higher. It's twice as high that of the post-tax Gini. So let me turn to Murtaza, a similar kind of question where you did hint at that in between because the political pressures are emerging now in Sri Lanka to change the design of the tax system, presumably because of this impact on income distribution. So I'll like to hear from you what you think is going on there.
So two quick stats. The top 20% of households get 51% of the income and about 46% of expenditure. So most of the burden sharing of any adjustment has to be focused on the people who can pay taxes. And unfortunately, not only in terms of the tax redesign, but even the debt restructuring, that burden sharing was not imposed on the people who should be paying for it. It was just postponed for another day. Similar to what Ijaz said, we also had problems with energy subsidies. It seems to have been in South Asian Malays. I look at all the South Asian countries. Actually, the only country that seems to be doing it rationally is Nepal, who seems to be the poorest of the countries because in terms of the taxation to the retail pump price, they have some of the highest taxes. And countries that have eternal balance of payment problems, I mean, mispricing fuel is bad policy. And for some reason, Sri Lanka has been mispricing, mistaxing, undertaxing fuel for many years, which they have now corrected because there's a formula-based pricing. The second is that we have also now put in place a proper cash transfer system. Not all the cash transfers go to bank accounts, but the target is only 0.8% of GDP. And although we are in the IMF program, this was one of the things that we underspent, that because of capacity issues, that all the allocated expenditure was not properly spent. And I'll give you a case in point that the new government tried to give relief to the new school kids for the school year. Our school year starts in January. And they were toying with the idea of meddling with the VAT rate. But then they held back and said that, no, we'll just pass a cash transfer to the people who really need it and just leave the VAT rate. So that's a much better way of doing subsidies than going and meddling with the tax because it creates distortions. And in the case of fuel subsidies, the World Bank did an analysis based on household income and expenditure survey, which showed that 70% of the benefit of any kind of subsidy or tax subsidy or lower rates of tax goes to the top 30% of households. 70% goes to the top. So it's a completely misdirected way. The other thing is that Sri Lanka has a penchant for giving tax concessions, tax holidays. They believe that the only way of getting investment is to give sweeteners. And now this so-called race to the bottom and this minimum alternate tax rate of 15%. To just give you an example, there was a new port terminal built in Sri Lanka by Adani. He's 51% owner. And if you look at the map, Sri Lanka has a fabulous strategic location, and most of the ships that sail down the Indian Ocean go through past Sri Lanka. So one questions, why do you need to give tax incentives to build a port terminal in a highly established port? And we went and gave 25-year tax holidays. So some of these things are unjustifiable also. And finally, I think the report touched on wealth. I kind of disagree with taxing wealth, but I agree with taxing property. Property prices, because of urbanization, have outpaced the growth of nominal GDP, certainly in the more populous and more prosperous areas of Sri Lanka, and it's massively undertaxed. We do have a statute at the municipality level to tax property, but the assessment and the rate of taxation is woefully inadequate. Now, according to our constitution, the property is a devolved subject, so the revenues wouldn't have come to central government, but the central government is doing a lot of transfers, and we could have a better matching system if we significantly increase the collections from property taxes.
Thank you, Murtaza. So let me sort of conclude, we've had a very extensive discussion. And first of all, I'd like to congratulate Francisca for choosing the topic, looking at the discussion that has taken place, a very relevant topic for the region. And one thing that comes out from the discussion is that there is potential. There's a lot of potential in the region to raise revenue. So the studies which have been done are not wrong, that given the will, given improvement in systems, there is a chance to raise more revenues. And at this point in time, given what's going on in the world, this is going to be one way to stabilize the economies, to generate more resources, to support development, to support achievement of SDGs, and so on and so forth. And a couple of suggestions which have come out from the discussion, which will help raising revenues, is, of course, I think I heard 2-3 of the speakers emphasize tax concessions, what people call generically tax expenditures. The expenditures, the tax expenditures, the estimates for these, they range from about 2 or 2.5% for developing countries, to the extent that we are able to estimate them, to 4.5% for advanced economies. And they're centered on basically corporate side and on the VAT side. And so these are the two sort of areas which cost the most in terms of tax expenditures. And that would have to be focused on in going forward, but it's not an easy area to deal with, as we have seen in a number of countries that have tried to get into it. I can't think of many countries which have had successful reform of tax expenditures. And then an area which I think has come up in the discussion is avoiding multiple rates of VAT. This complicates the tax administration. It doesn't generate more revenues. The ideal system is really to have one rate, but that is going to be impossible in the circumstances that we are living in. But having many, many rates makes it extremely difficult for tax administration to implement the tax system. And of course, the point that Murtaza has made about high threshold for VAT is absolutely right. The reason we advocate a threshold is to ensure that poor people don't end up paying for the VAT. This is one way to exempt the consumption of the poor. And by raising it so high, you even bring in the middle class in the system. So it's really eroding the tax base. Of course, I agree with Murtaza that one should not be going to tax the wealth per se, but income from the wealth should be taxed, which is interest income. It should be taxed well, capital gains income, and so on and so forth. And in most of the countries, this is a problem. And we don't necessarily have to tax the wealth, because as Francisca said, people will just move away their resources to some other countries. So, but income from wealth is certainly holds potential. I think with this, I'd like to thank the panel for an interesting discussion, making the time to join us today, and for Francisca for making this happen. And thank you so much, and goodbye. Thank you.
Thank you.